Welcome back, you legends. I'm Dr. Khan. Let's get right into this video. A signal is about to trigger tomorrow on CPI that really hasn't been seen since the pandemic. That's right, since the pandemic. So let's get right into it. The S&P 500 today was basically flat, entirely unchanged from yesterday. We opened flat, rallied, then gave back all of those gains towards the end of the session. The NASDAQ is down about a half a percentage point and the Dow is up about 1/3%. Let's take a look at the stock market map. Same thing that we saw yesterday. Big cap tech companies, Microsoft, Apple, Google, Meta, and Amazon giving back all of those gains. On the flip side, guys, we had basic materials, energy, financials, industrials, real estate, and utilities leading. This is a combination of defensive sectors and inflationary sectors. Again, this is telling that the market expects tomorrow's CPI to show inflation remaining a very sticky, very hard for the Fed to fight. Tech and communication services, these are the sectors that led the market up from the March 13th bottom after we had the run on the banks, the SVB collapse, Signature Bank, all of those banking issues cropped up. We had the money flow into the tech and communication services. Those sectors allowed the S&P to continue to float up even though financial conditions tightened significantly and the overall picture for the stock market looked much more grim, but those companies are now giving back most of those gains recently. Now, I want to talk about the signal. This is the signal, folks, and it's an extremely rare signal, and it's about to trigger tomorrow. How do I know that? I'll get right into that in a second. This chart, guys, demonstrates headline CPI divided by core CPI. And I've highlighted really every single time this signal was triggered. So let's take a look at it here. And the last time this has happened, guys, was back in the pandemic. So up top is the ratio between the headline CPI and the core CPI. When we're at 1, it means that headline and core CPI are exactly the same. In a healthy economy, you want to see headline CPI outpacing core CPI because that means that there's demand for materials, for lumber, for copper, all of those commodities. And at the same time, it means that the currency is stable. When you see core CPI outpacing headline CPI, you see this ratio dip below 1. And that usually indicates two things, guys. Number one, demand destruction for commodities, which indicates that the economy is weakening. Number two, it indicates that the Fed has been heavy-handed. It has printed too many dollars and it ended up really devaluing the currency. So it means two things. Number one, the economy is weakening. Number two, the currency has been devalued. And if we take a look, guys, at every single time headline CPI came below core CPI, you will notice that it was during times of significant economic sickening, right? So it was back in the pandemic. It was just before the double dip recession of 2015 and 2016. It happened again in the mini recession of 2012 and again in the mini recession of 2010 and at the big kahuna, the recession of 2008, right? So all of these times are bad times, right? And why do I say that core CPI is going to come below headline CPI? And that's because, guys, the Fed is projecting that's exactly what's going to happen. Here it is, the Fed nowcast model for inflation, March 2023, CPI headline at 5.22. Core CPI for the first time since the pandemic will come higher than the headline number. So tomorrow, guys, we'll have inflation year on year and core inflation. Both numbers are going to be coming out before the market open at 8:30 a.m. Eastern time. Last month, we had inflation come in at 6%, core inflation at 5.5%. This time around, we're expecting that core inflation will come out at 5.6, so flat to slightly up, and then a headline inflation down significantly from 6% to 5.2% to 5.3%. So guys, what this means basically, the Fed has devalued the currency, the dollar is weakening. We can clearly see that in the chart for the dollar. Really, since the end of last year, since October, the dollar has been significantly weak. And this weakening will likely continue as soon as the Fed announces a rate hike pause. As soon as the Fed announces a pause, which is likely coming at the next meeting on the 5th of May, we will likely see the dollar continue to collapse, and that will only make matters worse for the Fed, because even if demand destruction is strong, it is real, and we start to see commodities continue to decline, when the dollar weakens, commodities instantaneously and simultaneously become more expensive, because commodities are traded with dollars. So when the dollar declines, commodities automatically go up in price, even when there's demand destruction. So we have this pretty bearish signal cropping up likely tomorrow. I haven't seen anybody talk about this. I'm honestly quite shocked. Haven't seen anybody in the financial realm on YouTube, on TV, anywhere, on Twitter. Nothing. Nobody's talking about this. I'm quite shocked. And these statistics are quite bad, guys. Every single time we had the stock market weaken, and so we can expect the market may rally just a tiny little bit going into the Fed meeting. If earnings are not as bad as feared, if earnings are pretty bad, we'll start to see the market weaken immediately, probably beginning next week, when we start to see all of those earnings start to flow in. Let's take a look at the daily chart for the S&P 500. Again, we are unchanged from yesterday. We gapped down Monday. We gapped down Friday, then we rallied, again gapped down Monday, then we rallied today. We pretty much closed flat on the day. This signals a massive indecision in the market. It is waiting for that CPI report that's coming out tomorrow. Look at this extremely weak volume, really anemic volume. We will likely see an explosion in volume tomorrow on CPI as all of those funds with parked cash begin to deploy cash, depending on what happens with CPI, right? We might see money flow into commodities, we might see money flow into bonds, we might see money flow into specific sectors in the stock market. The expected move for tomorrow is about $4 in either direction. So we're looking at 414 to the upside and about 406 to the downside. That's not as big of a range as you'd expect, right? It's not as big of a range as you'd normally expect. So I'm thinking that the market will likely see a move even larger than the expected move going into the end of the week. And that will likely send volatility higher if it happens. Volatility really hasn't done anything for quite a while now. For a couple of weeks, volatility is unchanged and nothing has happened. We closed at equilibrium today. We had several rejections of every breakout in the VIX in the last 4 consecutive sessions. Today was the first day where we had volatility come down and then revert back to the towards the end of the day. The 5-day moving average is curling over. But again, tomorrow is going to be pivotal. It's going to be a binary event. And we'll look at two things. Number one, if we start to see the VIX breaking out, that will likely signal a significant sell-off in the S&P 500 beginning tomorrow. If we see the opposite, if we see the VIX getting crushed, gapping down tomorrow at the open and continuing to go down, we will likely see the VIX revisit these lows back at the 17 reading, and the S&P will likely again rally towards that 414 target. And that's an important target, guys, because we do have this gap sitting at 414. We have another gap right here sitting at 415. So anywhere between 414 and 415 tomorrow to the upside and 406 to the downside. Right now, based on what I'm seeing from the technicals, I am leaning slightly to the upside. I do think we will likely see a rally to the upside. Again, 414 to 415, and that will likely give us a double top. With a negative divergence on the smaller time frames. I'm looking at the 1-hour chart and the 2-hour chart. We will likely rally all the way up to the upper edge of this channel, form a double top, and then move towards filling those gaps below. We have 1, 2, 3 gaps down below, lots of gaps. And so from a bullish perspective, we are still trading above the moving averages on the smaller time frames. The PPO on the daily chart is still positive. The RSI is above 50. So bulls do have momentum on their side. And again, I do think that technicals do favor a slight pop here before we drop. So expect a pop and drop, and that will likely send us back to fill those gaps all the way down to 396. That's what I'm looking at right now. Let's take a look at the Dow Jones. The Dow Jones is getting very close to tagging this significant resistance line. It has acted as major resistance throughout the Dow's rallies since late last year, and I do not expect that to be different. If anything, if the market decides to rally on CPI tomorrow, it's likely going to be driven by a rally in the NASDAQ. The NASDAQ has significantly weakened. The PPO is still positive, only very slightly positive. Very similar look to what we had back here. So again, we might see one final pop before the next drop, right? A pop and drop, double top on the triple Qs and the S&P. That rhymed. I did not mean for that to rhyme. Anyway, so let's go and check out the TLT, long-term treasuries. Again, weakening. We do have a double top here. Usually, guys, these mark tops. So we had a double top back in February, and it marked the top in the S&P. Another one, boom, right here, double top. Mark the top in December. So we have a double top. We will likely see again one final pop and drop in the S&P. That's just my opinion. Now let's take a look at gold. Gold is significantly weakening yet again. A double top. The PPO is slowing down, starting to curl down. We printed the first really negative read on the PPO histogram today. So gold is slightly weakening here. We might see one final push before gold really takes a breather here and goes back down to fill all of these gaps left down below, all the way down to 174. Personally, I'd be a buyer at 174. That's where I'm going to look to accumulate more gold. I'm still holding gold. I entered back here in early March, and I'm still holding. Let's take a look at the dollar index. So what's going on with the dollar, everybody? We had a reversal today, but we are very close to crossing over. If we get a rejection and we get a sell-off in the dollar tomorrow, we will again likely see a rally in the NASDAQ, in the S&P, even likely in commodities like gold, natural gas, US oil, etc. Let's take a look at the 10-year yield. 10-year yield is trying to find a bottom here, a double bottom here. No divergence yet. The first really positive read on the histogram since early March. Yields are clearly waiting for that CPI data release. If we get a pop here, I think we will end up a rally to 3.7, 3.65 to 3.7 on the 10-year yield. And if we get that, guys, we will likely again see a rally in the small caps, the IWM, the Russell 2000, and in commodities, oil, copper, all of those. Let's take a look at Google. Google looking pretty weak here. We tagged resistance. We got rejected immediately the second day. We are likely again coming in for one final pop before a major drop. A double top here, and the PPO is weakening, so we are likely soon finding a top in Google. Same thing in Microsoft. We are about, let's see, $10 away from realizing the full measured move from this double bottom back in January here. This is the full measured move. It should take Microsoft back all the way up to the August highs at $295. And at that point, I think Microsoft will find a local top. Apple, same thing here. We tagged the resistance line perfectly here, and then we had a rejection. We broke in below this ascending channel. I pointed out yesterday what happens after we break below this ascending channel. Usually, guys, that means the S&P has already topped or is about to top in the next 5 days, and I'm favoring right now a top coming in post CPI here, a double top, boom, rejection, and we come back down, pretty similar to what we had back in February. Let's take a look at AMD, the stock that could tell the future. And again, this stock, this dip right here, this switch from green to red alerted us to the sell-off that came in the S&P right here. This is the S&P in blue and black. Really, we went short based on what happened in AMD. We went short here. and I closed my shorts at the open on April 6th, and I'm still waiting on cash, waiting for that CPI release to really deploy some of that capital into trades. So what's been happening with AMD? Just like what we said yesterday, AMD has sold off. We did say yesterday that AMD tends to do this, right? It tends to rally to the 20-day moving average, then sell off. Tends to rally to the 20-day moving average, boom, and then sells off when the PPO is negative. The PPO is negative, we rally to the 20, and then we sold off. We could see a pop tomorrow, one final pop. That is still possible, but again, the trend remains down for AMD and the rest of the semis, including NVIDIA and the SMH sector in general. Let's take a look at the summation index. Here, guys, this is a pretty simple trend finding tool. When we get a cross up, we get an uptrend. When we get a cross down, we get a downtrend, right? Cross up, uptrend, cross down, downtrend. We are still trending up on the summation index. So any pullbacks here will be met by buyer demand as long as the summation index remains positive and trending up. This summation index is for the New York Stock Exchange. The summation index for the NASDAQ looks significantly weaker, again suggesting that we will likely find a top here soon, especially as stocks like Google, Microsoft, Apple, all of these tech companies finding resistance here. Now, meme stocks, Bed Bath & Beyond, a company that's gone bankrupt. Basically bankrupt, this company is, and it rallied today. Exactly as we expected yesterday. We had that golden cross on the meme index, and we expected meme stocks to rally, and we got that today, right? We had the first rally in Bed Bath & Beyond, really, I don't know, since when? Since March 10th, if you can believe that. This was the first pop. We had a rally in Carvana. We had a rally in MicroStrategy, in Amara, in Coinbase. All of these meme stocks, all of these crypto-based stocks, all of them rallied based off of that golden cross, the 50 crossing the 200 daily moving average. The meme index is now threatening to break out of the symmetrical triangle. And by the way, guys, this does not mean that the economy is healthy or that you should go and invest in these or anything like that. This is very common. Meme stocks usually rally after the fear and greed index crosses 50. We did get a cross above 50 back towards the end of the month, and we are now finally seeing that FOMO, fear of missing out, all of that greed trickle into meme stocks. Usually, guys, the market does find a top around the 75 reading. That's when we found a top back in December of last year, and again when we found a top back in February of this year. Market momentum is flagging. We're still flagging, doing nothing, waiting for a week. Now, waiting for that CPI data that's coming out tomorrow. Stock price strength is improving. Breadth is improving. Put-to-call ratio continues to decline and will likely continue to decline from this point on. Market volatility is trying to curl back up, trying to rally here. And guys, remember volatility. When volatility rallies, the S&P comes down. Stocks in general do not like volatility. And so when volatility moves up, the stock market does go down. Volatility is trying to find a breakout here, but based on everything we've seen in the last 6-7 trading sessions, every single time volatility has tried to rally. Look at this gap up, then sold off, tried to rally, reject, tried to rally again, reject. It rejected every single time. And again, the overall picture, if you are a bear, this is not the picture that you want to see from the VIX. The VIX, again, will likely break below the 18.5 level all the way down to 18 and even 17.5 if the market decides to rally on CPI tomorrow. This usually happens, guys, when big events come and you see a big data drop. Usually, guys, all of that volatility that's priced in before the event, it gets priced out of the market, and that pushes the volatility index, the VIX, down. Now, tomorrow for inflation, the market is expecting a $4 move to either direction. And in terms of readings, we're expecting a reading of 5.5 to 5.6 on the core rate and 5.2 to 5.3 on the headline year-on-year rate of inflation. According to the nowcast, we are likely to see those numbers, right? 5.2 on the headline, 5.66, so about 5.7 on core. And if we get a high core reading and a low headline line reading, I think we'll probably see a rotation into safety. Again, defensives, gold, all of these things, because again, this is a very negative, very rare signal. That's all I have for you today, guys. Thank you so much for watching, and I'll catch you in the next one. Bye-bye.
Oh, wow.